All right, everybody, welcome back. We are about to take another deep dive today.
That's right, another deep dive.
And this time we're looking at finance models.
Finance models, yes.
Now, this is something that I think a lot of people are intimidated by. And, you sent in a bunch of articles.
That's right, a lot of listener requests on this topic.
Yeah, and you want to know how these things work, and I don't blame you.
Absolutely. It's a fascinating world, and believe it or not, you don't need a PhD to get the basics.
No, you don't need a PhD. And honestly, I think a lot of people with PhDs even get this stuff wrong.
Well, there's definitely a lot of complexity, but our goal today is to kind of break it down.
Yeah, just demystify it a little bit.
Exactly, make it approachable.
So where should we start? I mean, you've got all these articles in front of you.
Well, there's one that really jumps out, and it's actually a classic, and that's the Black Skulls model.
Black schools. Yeah, I've heard of that.
It's pretty famous, actually, won a Nobel Prize.
They won a Nobel Prize.
Yeah, back in 1997.
So it must be important.
It's incredibly important. It really revolutionized how we think about options pricing.
Options pricing. Okay, so we're talking about stock options and things like that.
Exactly. So an option gives you the right, but not the obligation to buy or sell an asset at a certain price in the future.
Right.
And the question is, what is that right worth?
How do you put a price on that?
Yeah, that's the million-dollar question, and that's where Black Skulls comes in.
Okay, so how does it work?
Well, it's a mathematical model that takes into account several factors. So you've got the current price of the underlying asset.
With the stock price.
Right. The stock price, you've got the volatility of that asset.
Volatility, so how much it jumps up and down.
Exactly how much it swings. And then you've got the time until the option expires.
So the longer you have, the more it's probably worth.
Right. And then you've got interest rates and a few other things. And you plug all those numbers into this formula, and it spits out a theoretical price for the option.
So it's like a prediction machine.
Not exactly. I wouldn't call it a prediction machine. It's more of a framework for understanding the probabilities.
Okay, so it's not telling you what's going to happen.
No, it's not telling you that the stock will go up or down.
Right.
It's giving you a way to assess the likelihood of different outcomes and price the option accordingly.
So before Black Skulls, how did people price options?
Well, it was a lot more guesswork.
Really?
Yeah, there was not this rigorous mathematical framework.
So this was a big breakthrough.
Absolutely, it transformed options trading.
So did it make everything foolproof, though? I mean, is Black Skulls perfect?
That's the catch-no model is perfect.
Okay.
Black Skulls relies on certain assumptions about the market, like the idea that markets are perfectly efficient.
And that doesn't always happen.
Right. Real-world markets are messy. They can be irrational.
So there are limitations.
There are definitely limitations, and it's important to be aware of those.
So is it like a weather forecast?
Yeah.
Then, sometimes you get it right, sometimes you get it wrong.
That's a good analogy. It can give you a general idea, but there are always surprises.
Right, those freak storms.
Exactly. So you got to take it with a grain of salt.
Now, one of the other things I was reading about was Monte Carlo simulations.
Oh, yeah. Monte Carlo simulations are fascinating.
These sound kind of fun, actually, like running a million different scenarios through a computer.
That's exactly what it is.
Yeah.
It's like playing what if on a massive scale.
So how is that used in finance?
Well, let's say you're a bank and you want to know how your portfolio of loans would perform under different economic conditions.
Okay.
So you could use a Monte Carlo simulation to model thousands of different possibilities, interest rate hikes, recessions, housing booms.
Wow.
And by running all those simulations, you can get a sense of the potential losses and risks.
So it's like a stress test.
Exactly. A way to stress test your portfolio and see what might happen.
That's pretty cool. And I guess you could use that for other things, too.
Oh, absolutely. Investment management, pricing, complex financial instruments. It's a very versatile tool.
It's like a video game for finance professionals.
Haha. In a way it is, but with real-world consequences.
Right. High stakes.
Exactly, high stakes.
Okay, so one last thing we have to talk about, and that's machine learning.
Yes, the elephant in the room.
It's everywhere these days.
Yeah.
And everyone's saying it's going to revolutionize finance.
And it's true, machine learning has incredible potential in this field.
So what can it do?
Well, imagine you have mountains of data on stock prices, trading volumes, news articles, social media sentiment.
That's a lot of data.
It's overwhelming for a human to process, but machine learning algorithms can sift through all that data.
And find patterns.
Exactly. They can identify patterns that humans might miss, and those patterns can be incredibly valuable.
So you can use that for trading?
Absolutely. Algorithmic trading is a prime example where these algorithms can analyze market data in real time and execute trades at lightning speed.
So it's like a super trader.
In a way, but it still requires human oversight.
Right, because what if the algorithm goes rogue?
That's the concern. There are always risks. And we need to be careful about how we use these powerful tools.
Like any technology, it can be used for good or for bad.
Exactly.
So stepping back from all the technical details, why should someone who's not a quant care about any of this?
That's a great question, and I think the answer is that in a world increasingly driven by data and algorithms, financial literacy is more important than ever.
I agree.
Understanding the basics of how these models work can help you make better decisions about your own money, your investments.
And even just understanding the news.
Absolutely. A lot of financial news is based on these models, so if you know how they work, you can be a more informed citizen.
So it's not just for Wall Street anymore.
Not at all. It's for everyone.
So as these models continue to evolve, what do you think the future holds? What's next?
That's the million-dollar question, isn't it? I mean, imagine models that can predict market crashes with accuracy or algorithms that can create personalized investment strategies tailored to your specific needs.
Oh.
It's mind-blowing. The possibilities are endless.
It's a little bit scary too, though, right?
Definitely there are ethical considerations as well.
Right. We have to make sure we use this technology responsibly.
Absolutely.
Well, on that note, I think we've covered a lot of ground today.
We have.
And hopefully this has been helpful for our listeners.
I hope so.
Demystified some of these complex financial models.
And maybe even spark some curiosity.
Yeah. If you're interested in learning more, there are a ton of resources out there.
Absolutely. Books, articles, online courses.
And I think the main takeaway is that you don't need to be a math whiz to understand this stuff.
Right. The basic concepts are actually pretty intuitive.
And once you understand the basics, you can start to see how these models are shaping the world around us.
And make more informed decisions about your own finances.
So keep exploring, keep learning, and stay tuned for our next deep dive.
We'll see you then.
Bye, everybody.
Bye.